Good morning. Today is Monday, September 8th, 2025. I'm Joe Terrell, president of Terrell & Company Private Wealth Managers in St. Louis, Missouri, and this is another video update of our thoughts on the economy and the market. Joining me today is Bill Newbold, Dave Carter, and Russ Phillips. Tricia Warner, who's also a member of our committee, is traveling today, doing a little bit of research for us. She'll be back for the next video. With that said, I wanted to say amongst the group our comments that August was going to be a quiet month was sort of correct, and then again, daily moves were volatile, but at the end of the day, markets were slightly higher. For those that are curious, in August, many of the major traders at hedge funds, mutual funds, pension plans tend to take off August, go to the Poconos, go to the Hamptons, go to Cape Cod, and it's not until when they return after Labor Day that you begin to get a true sense of what are people thinking. So we are after Labor Day now, and we're heading into, historically, the month of September, October are rough months on investment markets. Some of that comes about because the tax year for the same hedge funds, mutual funds, can end September 30th or October 31st. So they begin to sell all the things that maybe they have a loss in, so their year-end report shows nothing but winners. And sometimes it's truly for a tax purpose. So we're in hopes that we'll get some nice bargains as these funds tend to simply dump things because they have a calendar deadline facing them. With that said, who'd like to start off, and let's get some thoughts on the markets?
Sure. Well, thank you, Joe. I think I'll get it started. As Joe mentioned, I'm Bill Newbold, and we feel very comfortable where we're at here at Terrell & Company. We've stayed very disciplined. Our performance is good. We're taking less risk than the market is. And if you look at the S&P, it's up about 10.2% year to date. We continue to find that valuations are very high for the S&P. If you just take a step back, may be helpful. Q2 earnings were very good, so we have seen earnings estimates rise. But again, valuation levels are very high historically, in fact, at all-time highs. So we're staying very disciplined, and we're still finding some really nice value stories, names that have, self-help or restructurings and offer attractive dividend yields. So, one name in particular, a name like Verizon that's actually executing very well, offers a 6% dividend yield. They're paying down debt. They'll begin buying back stock later this year. We've been buying a name like Solventum, which
just
spun off.
By the way, increased their dividend this morning.
Yes, correct. And so another name, Solventum, which spun off from 3M. Nice restructuring story. They're selling some non-core businesses. So, we think it makes sense to stay disciplined, bring some dividend yield into the portfolios. And again, this can go on for a while, but it's very, it pays to stay disciplined in this environment.
Bill, let me bring up, and Russ and Dave, you can jump into it. Historically, price times earnings was a very good ratio to judge stocks on. In other words, for $1 worth of earnings, what do you have to pay? And right now, if I figure it correctly, on this year's earnings, the markets are selling at about 24 times earnings.
Correct.
If earnings growth next year comes in, and that's a big if, then what it would be, we'd still be at 21, 22 times earnings.
Correct.
am I correct, Russ, you're more of a historian than I am, but isn't 16 to 18 times earnings closer to the historic norm? Or is there something about today's world that we're in a brave new world that no, this is normal to see things sell at these elevated prices?
Thank you, Joe. I think you're asking a couple of questions there. I think, are we in a brave new world? We've seen the brave new world several times, and we know how that eventually ends, right?
True.
We also have seen a period here recently coming out of COVID 2008 when interest rates were zero. I know we suffered as a team through that. Joe and David did. Bill and I joined right after that, thankfully. Timing was good. But you know, when rates come down, multiples can be higher. And as we know, the Fed is meeting next week. We like to talk about interest rates, the markets, and the economy. Well, let's talk about those for 2 seconds. Interest rates, the Fed meeting next week. I believe, and David's better at this than I am, I think we at least have 100% probability that a 25% rate cut's coming next week. There's now even sneaking in the potential for a 0.5% rate cut next week.
But this is well expected, and these are already built into prices, whether it's yields on 10-year government bonds or whether it's stock prices. As you say, it's 100% expected. They already have this built into prices.
I think you've nailed it. I think what could surprise investors is the fact that it's discounted in the markets and rates could actually go up, stocks could go down. That said, our portfolios have done reasonably well with the 30% stock allocation. We have names like Citigroup hitting all-time new highs. We have a name like AT&T hitting all-time new highs. Warner Brothers Discovery has done very well for us. KRE, the regional bank ETF, has
It's
done
off
well.
its high, but Disney
Disney
is a
is
big
another
holding for us,
quality
so that's
holding.
doing well.
And those are the type of names we look for. So I think overall the economy is strong. People have jobs. We know from taking calls from our clients, and we, by the way, thank you and appreciate your business. People are spending money. If they have a job and the market continues to stay high, until one of those things cracks, I think we continue to see the market do what it's been doing.
Well, could it be, in my opinion, the continued rates of inflation? Obviously, I'm not a normal consumer, but I'm just floored at what it cost me Saturday to go to the grocery store. And I wasn't buying, you know, the high dollar items. I was buying basics.
I think your story is, resonates with just about everybody at this table and people out in the real world.
Well, Dave, do you think it could be inflation that could upset this perfect story that Wall Street has developed? Lower rates, higher earnings, AI, everything's going to work perfect. Could inflation surprise to the upside? And or the other thing that we talk about, I worry more than the rest of us, is financing the federal budget deficit. Could one of those two things upset this and actually see where rates don't on a 10-year bond go down to 3.25, 3.5, like the markets are thinking?
Well, I think
even if it
that's,
stays unchanged at 4.25, 4.5 range.
well, I think you may be onto something there, and quite honestly, I worry about stagflation, where we have had a couple of soggy jobs reports, still positive, but they were soggy, and that's given the Fed the courage to be more aggressive in cut rates and that. But I find it interesting on a global basis that Japan, Germany, Britain, Great Britain, the global central banks have lowered their Fed funds rates, their money market rates, but their long bonds are selling at, I don't want to say historic highs, but decade highs in the face of lower rates. And in the same breath, we're seeing a strong bid in gold at $3,600 an ounce, which is an all-time record, and that appears to be pretty solid. And so why is that? I think it's deficits. I think people are starting to be concerned about the budget deficits and government spending. I think it's that simple.
You very well could be correct. Anyone else want to add anything, or we'll save it for our next video? We'll probably come back. Brian Curtis, our producer here. Brian, let's put down the day after the Fed meeting, which is September 17th, I
Yes,
believe.
they meet on the 17th, so.
We'll come back with a update on our outlook. But I do find it interesting that we're up 7 to 8% this year with a very modest allocation towards stocks because our fixed income's doing well. What stocks we own for the most part, as you mentioned, Russ, are doing well. And we'll see if we can't keep that up. So with that said, thank you for tuning in. Brian Curtis, as I mentioned, thank you for doing our video updates. We'll return. Thank you.
Thank you.
Thank you.
Thank you.